Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at Auspice. Let's get across what we saw overnight. Wall Street indices retreating with oil prices up around 5% overnight. The market's focused on the outlook for the Federal Reserve, interest rates, and on a potential deal between the US and Iran to reopen the Strait of Hormuz. Now, stock specifically, shares in Nvidia dropped after a group of financial firms, including Apollo and Blackstone, reportedly working with Nvidia to put together a $500 billion funding package for AI infrastructure development. Also weighing on the market, Intel, that fell after the chipmaker said it was planning to raise $15 billion through a share sale. Well, US President Donald Trump has responded to Iran's conditions for a peace deal with his own demands that Iran pay compensation for people killed in wars, attacks and protests over the past 50 years. His proposal, which has not been raised before, was a response to Tehran's demands for compensation and an end to sanctions. Iran's foreign ministry saying as long as hostile actions continue, the conditions for ensuring the safety of this waterway are not in place. Its reopening is contingent on the US ceasing its illegal actions, lifting the siege and compensating for damages. Well, the US two-year Treasury yield rose to 4.24%. The 10-year was at 4.71. Australian three-year government bond yield futures rose to 4.58%. The 10-year up to 5.04. Markets pricing in a 5% chance the RBA cash rate, currently at 4.35%, will be hiked by 25 basis points at today's meeting, and a 65% chance by December. US dollar index was up around 0.1%. The Aussie is currently at 70.6 US cents. Gold was up overnight. Bitcoin dropping to around 64,000 US dollars. So let's get across what is moving markets at the moment, and ahead of a key read on inflation out of the States this week as well. Joining us, Steve Sosnick, Chief Market Strategist at Interactive Brokers. Steve, welcome back to you. So I was just taking a look at your note. You're saying it's a bit of a ho-hum session to begin the week.
Yeah, I felt really bad. One of a print reporter called me and asked for like market color, and I'm like, I have no idea what to tell you. There's really nothing going on. You could see the indices closed pretty much dead flat. There were slightly more decliners than advancers, but this was kind of it was a summer Monday, not a lot of catalysts. Stocks did their best to shrug off the fact that bonds and oil were disappointed in the lack of progress over the peace talks, but this is nothing we haven't seen before. And so, the excuse was, let's wait for the CPI and the PPI numbers. And there was really no impetus to buy or sell today.
Well, speaking of that data, let's just take you back to last week where we had the non-farm payrolls, which was certainly pretty weak, wasn't it? I mean, maybe that's a bit of an understatement. But what do you make of that, in particular, I guess, the way the Fed is looking at that? Because obviously it has that dual mandate, the jobs and inflation. The focus has very much been, though, on inflation.
Yeah, that's what kind of caught the market by surprise to some extent. Kevin Warsh has portrayed himself pretty much as a single mandate Fed chair, fighting inflation and sort of taking labor as a fait accompli. I actually went and counted this. I counted the number of times he said inflation at the last press conference, and it came up 41 times. 29 of the times came from Warsh himself. And then I counted the number of times labor was mentioned. It was 4. 3 of them were in response to the single question that was the 4th time. So the market had really been sort of assuming that labor was out of the way, which was a different place than where we were earlier in the year. And now we're back. We have to consider it back on the table. I mean, the numbers, there was really no way to slice them as good numbers, except for maybe the fact that the unemployment rate went down to 4.1%. But that was more because people are leaving the workforce, not because people are having any easier time finding jobs. It was the denominator of the equation that fell more than the numerator in this case. And so it was not a great, there was no way to spin this, except for the fact that the market said, okay, if the labor side of the economy is not, is in trouble, or to some extent, or at least not, can't be assumed going well well, then maybe that takes some of the pressure or the ability of the Fed to hike rates at the next meeting, which had about a 65% chance before the number and about a 40% chance after the number. So we did get a rally in the bond market. But my comment about that was also during the press conference, he said something to the effect of he was very happy because the market seemed to be playing the ball, not the meaning the referee, meaning that they were responding to the data, not to the Fed's response to the data. And I'm going to say that on Friday, my piece on Friday was they're playing the referee. The only plausible reason for the stock market to rally was optimism that rate hikes would be pushed back, probably till December, if not beyond. And so this, you can't say that that rally was about data.
Yeah, it's what are the expectations for inflation this week?
Well, I mean, they're looking, sort of that 0.2 to 0.3 range, depending on which measure you're looking at on a monthly basis. We got a positive surprise last quarter. It's going to be difficult to sort of tease out the core from the headline number because we had seen improvement in oil prices. That seems to have found a little bit of a level. It's a bit of a moving target. I think in general, as long as the numbers are not completely out of whack, you're going to get this continued feeling that the Fed continues to buy time. I think Warsh has been, that's really been his move right now. He put together the 5 task forces, and he can very plausibly say, I'm not going to do anything until those task forces give me their reports. With the president being so enamored with the idea of rate cutting, and Warsh being sort of inherently hawkish, I think it gives him time to not have to consider raising rates until after the midterm elections, which would put us into December. And I think that's why the markets are sort of looking out that way, barring a big surprise one way or the other. Well, if it's a positive surprise, then you may see the rate cut expectations go down even further, and well, they should. But I think unless it's a truly awful inflation number, which nobody's really pricing in right now, you'll see the rate hike expectations stay manageable.
Steve, can I return to the equity market and your assessment of earnings season? Look, we're sort of near the end. I think we've got, about 60% of the S&P 500 companies having reported.
Something like that.
I was taking a look at the numbers, in fact. 86% positive EPS surprise, 77% beating on revenue. What's your assessment of what you've seen thus far?
Well, I mean, I think undoubtedly this quarter is being considered a success, and if there's ever a good reason for stocks to be putting in a good performance, it's because they're getting good earnings. I never put too much stock in the idea of 86 or 22, 82%, whatever it is, beat on earnings. Even in the bad quarters, 70+% of stocks beat on earnings. I think that's more as much a testament to CFOs being able to manage their analysts as much as it is to manage their actual numbers. But on the other hand, you can't deny that these numbers have been positive. Also the actual growth rate has been double digits. It's hard to come up with a concern for this other than thinking that are people extrapolating the last 2 very good quarters? How far are they extrapolating them out? We've had double-digit earnings growth, which is great, but ultimately, can you sustain double-digit earnings growth in an economy that's got a nominal growth rate of, call it 5 to 6%? Management is talented, but at some point, there's a baseline that you have to react to. I think a lot of the numbers were benefiting this quarter on tariff refunds, benefiting on accelerated depreciation, beneficial depreciation that came out of the last tax law, and so. Can they sustain this? And so the question becomes are we pricing in another 1 or 2 quarters of great growth, or are we pricing in 1 or 2 years of great growth? One is probably doable. The latter is probably difficult to achieve, and that's one of the concerns that I think some investors have, even despite reason for enthusiasm about the earnings reports.
Well, and further to that then, any reason why we won't see the market continue to rally into the end of the year?
I think the biggest headwinds for the market are more existential right now, and you actually raised two of them at the top of the hour. And that is the immense amount of capital required by, in many cases, the companies that are driving the bus economically. NVIDIA needing $500 billion of capital, Intel selling stock into a strong market. The supply demand dynamics for the market have changed dramatically pretty much since the global financial crisis. We had two big tailwinds. Low interest rates allowed private equity and other corporations to buy companies for cash. At the same time, you had companies spinning off loads of cash and retiring shares through buybacks. Well, a lot of you really have private equity. I'm not going to say completely out of the game, but I think they'd rather be sellers than buyers with interest rates where they are. They already have a bit of a backlog, especially with private credit being, I'm going to call it iffy. Then you have the biggest cash flow generators needing cash. You flipped some of these companies that were just routinely spinning off loads of cash and buying back shares, and now they're turning issuers. Plus, you have the unlock of the SpaceX shares, which, by the way, I think people overestimated the immediacy of that selling. The corporate insiders are not dumb. They're gonna wait their time, and that's why the stock bounced, even though the overhang was there. But you have potential Anthropic deal, you have potential OpenAI deal. There's a lot of requirements for liquidity out there, and I think this positive tailwind that we got from a beneficial liquidity environment is, if not turning into a headwind, certainly not pushing back. So I think that's really the one of the keys here is the supply-demand dynamic that we're going to be facing, particularly as we see interest rates not offering us. At the short end of the curve, they might offer us a little improvement if the rate hikes are off the table, but the long end does not seem to be going down anytime soon.
Steve, as always, great to get across what you're seeing in markets. Thanks for joining us from Interactive Brokers.
My pleasure, Andrew. Talk soon.
Let's refocus on the local market then. We are expecting a fairly flat beginning. SPI futures down just 3 points. And look, clearly the focus today will be on the interest rate decision by the Reserve Bank. Expectations they will leave rates on hold. The question is just how hawkish or potentially dovish they could be in their commentary. And we'll get right across that from 2:30 Eastern. And also clearly a focus on reporting season. A number of stocks already out today, and we'll get to that in just a moment. Stay with us for the open.